Give me all you've got if you're prepared to break the silence. I'll be out in the sunshine, running beside the lion. I've been feeling down, but I've been looking.
Hello, welcome back to IPTD2H5D YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. If this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the bell notifications so you get notified each time I upload a new content. Try to like and refer this channel to a network so that YouTube push us to a high level of audience. Okay, you know, I don't upload video anyhow. I look at what traders are passing to. I look at the losses and the kind of some people trying to give up in the Forex synthetic market, and actually create video to solve this problem. Okay, in other words, I must have actually know what it means to have such problem, and I know the gravity of what it takes to solve the problem, and it takes me a couple of time to actually come up with a solution. Right here I'm going to actually be dealing with Forex and synthetic market as usual. If you don't have a synthetic trading account, check down the description of this video to create account with a synthetic broker. Don't Google the broker on the website to avoid meeting group site. Right here, the topic we shall be discussing is supremacy of taking risk or the right conditions in Forex synthetic market. Okay, so that is the topic we shall be discussing. Okay, you see, that is one major sickness a lot of losing traders have, and that sickness is when they see the right trade, they become afraid to take the trade, or they must have lost all their capital. And when they see the wrong trade, they will go ahead and take the wrong trade, and this is when they actually have the capital, and they will actually lose this capital. When they lose their capital by taking the wrong trade, when the right trade comes, they will not have capital to trade, or they might have capital to trade at all times, but they will be afraid to take risk even when the market presents the best condition. So this actually starts when your psychology has been compromised, when your interaction with the market is no longer, is no longer personal, it's no longer based on fact, it's not based on emotion, it's not based on fear, it's not based on greed. When you have these psychological problems and emotional problems, you will not be able to differentiate between good and bad trade. And so I want to solve this problem by launching this topic, supremacy of taking risk at right conditions. So once the time is ripe and the condition is right, make sure you take that trade. The only thing that changes is your ability to be flexible on your risk limit. So if you are afraid of this trade, but the condition is still right, but your instinct is giving you fears, then reduce risk. Maybe 50% of your maximum risk limit, you can reduce by 50% of your maximum risk limit, or by 75%, or by 25%. What it means is, if you are risking 5 to 10% and you are afraid of this trade, you can risk 3 to 5%. Okay, between the range of 3 to 5% you can risk. But if you are sure of this trade and the conditions are right, you can actually risk 5 to 10%. Okay, meaning that you can risk 5% or 6% or 7% or 8% or 9% or 10% of your capital. Okay, there are formulas for calculating loss sizes, because your risk limit have to synchronize with your loss size. So there is formula for calculating the loss size for a given trade, and these formulas are not going to state it in this video, but they are present in our VIPs, our various VIP like Forex and synthetic channels, good and Nasdaq or US 30 channel, boom and crash group or channel, and then our binary option channels and groups, which we are actually operating right now. You have to be there to see this formula for risk management. It is called risk management formula, right? You cannot find that formula with risk calculators. Risk calculators cannot actually help you to get all this, because these formulas were engineered by WFS team, and we have come up with what it takes to manage risk mathematically. And right here I'm gonna read this document. Some traders fail to take trade, okay, due to fear and psychological problems based on past losses. So your past is influencing your presence. Don't ever let your past to influence your presence, but you can learn from your past, but make sure your psychology and your emotion are not compromised, okay? In most cases 80% of such trades goes well and you start regretting. Once the market presents the right conditions to enter trade, just enter with your risk limits. Your risk limit must be fairly constant so that you can recover real losses in event of stop loss hits. So you might lose 2 trades in a row or 3 trades in a row, but because your risk reward is at least 1:2, 1:3, you can recover those losses with just one good trade. Getting the right condition with high winning rate needs serious dedication, smartness, and thorough analysis. So these keywords: dedication, seriousness, dedication, smartness, thorough analysis. You have to be ready to look on the chart before you do any, apart from praying to your gods, apart from your spiritual routine. Once that, before you brush your teeth or other morning routine or daily routine, you must first of all warn the market. I'm not being so personal with this, but for me, most time, like 80% of the time, I have to understand the market each day before I started doing other stuff that are not related to market, right? Because we really want to win in this stuff. It doesn't matter when you get a trade, the main thing is to make profits, right? So if you miss an opportunity in the morning simply because you are doing other routine of the day, you are doing other shots of the day, and you miss the trade, and then you wanna enter the trade at the wrong time and wrong condition, you can never blame the market or other entities. You rather blame your lack of dedication, smartness, and thorough analysis. Most analysis can take several stages of time. So thorough analysis means when you do your first analysis, you do it again, you do it maybe at different period of the day until you understood the market. You dare not enter the market without a full understanding of the market. You have to comprehend the market. The direction have to be correct. Everything have to align, both fundamentally, technically, and sentimentally, like a kind of moving average driven ideas. All these things have to be in alignment, okay? You must be good at understanding market movers and trying to get right condition to enter the market, okay? The market movers, you really need to understand the market movers, okay? You really need to understand the market movers. When you are looking for a trade, you dare not spend your time trading retracement. You really want to trade in a bigger move, like in a bigger where the direction where the move is going to be tremendous, or a kind of huge, because that is what lasts, that is what is sustainable. If you trade retracement, it can give you short profits and reverse against you, because the retracement is of short duration or shorter duration, why the impulse of big movers are of infinite duration. So are you trading zero driven durations like short term duration? Are you trading an infinite duration or long term duration? So find out what works. I'm going to be what works is actually to look for big movers in the market, smart money, institutional events. Okay, so that's what you need right now. I'm going to go to charts and show you some of these things. Okay, right now this is a derivative trading view, and this is for 24-hour or daily time frame. And right here I'll be using break and retest strategy, and then the zero differentials which are support and resistances. Right here we have a market that actually pump. This market pump from here, like there is a break of structure here. Okay, so we have a clear break of structure here. Okay, so we have a clear break of structure here. So in the daily time frame, the market actually move. Okay, so the market move from this point to here. I don't care about the sub break of structures or in between break of structure or intermediate break of structure. I care about the source and the destination. So this market reach that high and drop and tap into this zone. So this zone is a what? Is a broken level. So market came back and retested it, right? It's also a demand zone because the speed at which price left here was enormous, even though we expect a pullback, but it didn't happen. So the market has a very high bullish momentum. That's why the pullback had issue reaching this zone, and then the market fly. So this is a demand zone. So when price reach here, you dare not be afraid to take a buy at certain lower time frame. You dare not be afraid. So that's what I'm trying to say about the supremacy of taking risk. Just even if you risk $1 here. Okay, let me show you something. Let's use a long position. Okay, take for instance, you risk $1 here, and then you target this high. The risk reward is 1:8.68. That means you are making $8, right? But if you are just afraid, your $1 will be traded on a wrong trade, on a wrong signal, and you still lose it. Now, because it is $1, it might be like a shady stuff. When you reduce the risk further, okay, you'll be like, oh, this time around the risk, you have reduced the risk and you still want to risk $1. You have reduced the stop loss keep. You see, there are formula for this in the VIP channels and groups, so that's cool. So when you now target where the price is currently, the risk reward will go to 1:24. So if you risk $1, you are making $24, right? So if we amplify the risk from unity to a multiplicity more than one, like maybe $10, $20, $100, you are basically, let's assume $100, you are basically making $2,400. No stacking, no full margin trading. We are just risking a fixed amount, right? Like we are risking a fraction of your overall equity. We are not we didn't go full margin. What if you go full margin because you believe that this thing have to happen? Therefore, you have, let's say you have all you have in your account is $1,000, and you go full margin. Not to the full margin, you also stack. As the market go in deep profit, you reinvest your profit, of which these are treated in our mentorship and courses. So you stack, you deploy both stacking, sniper entry, you deploy full margin trading. Don't you know that this trade alone can actually take your $1,000 to $100,000, right? So that's cool, but I'm not going to show how this thing is going to be realistic, taking your $1,000 to $100,000 plus and beyond. But the thing is, mathematically, it can happen. Take for instance, you started with $1,000 and you go full margin with hope that this market cannot go against you by 3 pips. Okay, now since we are if you look at this take profit tool, you discover that we have we'll be taking our profit at a price of 2,305, and our entry was at 2,123. So the difference is around over 100 pips, right? So if you assume that this market cannot draw down by 3 pips, okay, let's take it 3 pips. So your risk reward is now 1:33, and then at first instance, when you risk your $1,000, you are running a signal that is 1:33, and so as this market starts progressing and start moving, the risk reward will increase gradually as it moves. So when it reaches a price of, when it breaks this level and reaches a price of 2,224, that means okay, I made a mistake. When it was here, the price difference will be around over 200 pips, so the risk reward will be 1:66. So when it is somewhere here, the price difference will be around 100 and the risk reward will be 1:33, and so you'll be running on $3,300. And then when you reinvest $3,300 and then you put more positions by reinvesting it with the original $1,000, when this market reach this high, as you start more, there are probabilities that you can be using lot sizes such as 100 lot size. So imagine using 100 lot size and the market actually reach here from here, so we have a gain of extra $100 pips. So your 100 lot size have paid you $10,000, and when this happen, you basically just one position, because you are going full margin. If you open up to 10 position doing this stuff with a belief that it's going to go in your favor, you have made $10,000 by 10. That is $100,000 total, plus the initial profits, which will be more than that, more than $100,000, right? So that's the power of taking risk. Okay, that's the power of taking risk. Okay, I can give another instance here. We basically have this market actually. You see, I'm just using one strategy, but if you are using this strategy alone, you will be making mistake, because it doesn't work all the time. Okay, because you have to combine other high level technical tools for this thing to work. So if you are using that idea, you see that when price get here, it break out, like it didn't respect the breakout, like it continue going up. Instead of the market to reverse here, it breaks. So it doesn't work all the time. So when you take the risk here, your risk management, if you sold here, your risk management would have actually saved you, right? So that's why you need to manage risk. But look at what's happening here. We have a break and a pullback, and the market continue going downwards until it reaches this demand zone. Okay, so just once you are right, just take risk. If you lose, maybe you risk 10%, you still have 90% to try, right? So that's why you need to be in our VIP to see the formula to actually risk that 10%, because most time when you place a trade, you might actually have risked 100% of your equity without knowing, because there is no mathematical formula guiding you, right? Right now we check this BTC USD. Okay, let's work on ZAR USD, which is good United States dollars, and I'll be in the daily time frame. Okay, let's be in the H4 so that we get a real entry. Okay, now this is the characteristics of ZAR USD. So good actually break this level. Okay, good, break this level. Okay, now when it break this level in the 4-hour time frame, then when it pulls back, when market is retracing, it is also having some level of energy, and the directional dynamics will make you not to just enter pullback anyhow. You have to consider the bandwidth as well. Okay, there are a lot of things you have to consider. So look at what happened here. When gold was coming here, you have to consider the turning point pattern or reactions and good pattern, like it is making lower highs, lower low, lower highs, lower low. So when this is a lower high, don't expect it to come here and react. You have to create a lower low and then pull back and create a lower high and then continue. So if they fail to respect this level, then it's going to fail. But if you are using risk management and you bought here, you can lose, right? Then your risk management should have saved you. But we have a break of structure here. Okay, so the next trade will win, right? So you risk your 10%, you still have 90%. Then when price tap here, you enter another trade, and that will be sell. Risk 10%. If you enter this trade and you risk another 10%, you have 80% left with your equity, right? So right now, let's get this short position, short 2, and then we enter a sell. We enter a sell there. Then we put our stop loss very little above, and then we will target. We can just target this other block here. Okay, and then what happened? The market drop with a risk reward of 1 is the 8 point something, and so if you risk 10%, you have made 80% gain, and you have invested 20% of your equity and you made the 80% gain, meaning that you have a net income of 60%, which is pretty much good, right? With a return on investment of 160%. Because you have to add 100% to 60, right? That's the net return on investment. So that's cool. The same thing goes for BTC USD in the 4-hour time frame. I'm talking about when you see opportunity, why should you be afraid? Learn how to be bold to take that risk. That's all, right? This is BTC. We wanna be in the 4-hour time frames, and right here we are still working on breakout structures. So we notice that is a break of structure here. Price, one funny thing is there are some break of structure that when you miss them, you will not be able to enter the market again. But in our VIP, we actually deploy high level strategies of generating such signal, meaning that we can still be buying in this market without being caught unaware, or without hitting our stop losses, having issue or getting triggered. Because what you don't know, you don't. That's why you have to leverage the effort of expert for you to go fast. So we have a break of structure and the market pulls back. After pulling back, it actually gained support near here. And what happened? You need to enter this trade. You can hold as much as you can with line frequency analysis, which I'm not teaching here. You will hold this trade till it actually change mode, or a kind of change season. Maybe if this is a bull market, so if it changes to a bear market, it will automatically go through geometrical transformation, and instead of making higher highs and higher lows, it start making lower highs and lower lows. Okay, and that is when you exit the trade. That is when you like, if you haven't exited, if you haven't exited, you will exit the trade at that point. And that's cool. I'll be ending this video. Make sure you are priority with the WFS or WinFS trading, and try to show up, like try to be proactive, like do something, invest, develop yourself, leverage our effort, build your capital so that you can be independent trader. But for you to be independent, you have to be dependent for a while before you can be independent. If not, you lose all the time, you keep losing, because you can't be a medical doctor and at the same time become a civil engineer. You must be good at one thing, and then when you master who you are and know how to do that thing on your own, then you can now be a specialty of that stuff on your own. So that's good. Thank you and bye for now.
You've got it if you're prepared to break the silence.